Hey, welcome back to Compounding Quietly. Most dividend investors don't quit because the strategy failed. They quit right before the compounding finally starts to show up in their account. That timing is not a coincidence. It happens to almost everyone who tries this approach at almost the same point. So why does the exit always come right before the reward? Let's think through this together. Right now, a lot of investors are sitting on a dividend portfolio that feels like it's going nowhere. The dividend checks are small. The price barely moves. Meanwhile, some other investor online is posting screenshots of a stock that doubled in 6 months. That comparison is where the doubt usually starts. It's not that the dividend strategy is broken. It's that the early years of dividend growth investing look almost identical to doing nothing at all. This is the part most people don't expect when they start. They expect a steady climb. What they get instead is a long, flat stretch that tests patience before it ever tests conviction. Somewhere around the 1-year mark, the questions start. Should I have picked growth stocks instead? Should I add more now or wait for a better entry? Here is the criteria that actually matters at this stage. It is not whether the price moved. It is whether the underlying dividend stream is still growing, quietly, in the background. If that growth is intact, the strategy is working exactly as designed. The market just hasn't caught up to showing it yet. What matters more than how dividend growth investing looks right now is why it's structured to look this way in the first place. Dividend growth investing is not built for a fast payoff. It's built on a compounding curve, and every compounding curve has a long, quiet, beginning before the visible acceleration. In the first several years, the dividend raises are modest, and reinvestment adds shares slowly. The math is working, but it produces almost nothing you can see. Then, later, the same percentage raise applies to a much larger base, and the dollar growth becomes obvious almost overnight. Picture an investor who started 5 years ago with modest, reinvested dividends year after year without increasing the amount. For the first 3 years, the dividend income barely changed. Then, in year 4, the income jumped noticeably, even though the strategy never changed. That investor didn't do anything differently in year 4. They simply stayed in the part of the curve where the growth becomes visible. That's the part most people never reach, because they exit during the flat stretch that comes right before it. Coming back to the original question, this is exactly why dividend investors quit right before it gets good. The flat stretch is the cost of admission, not a sign that something has gone wrong. The direction of judgment here is simple. The decision to hold is not about predicting a turning point. It's about recognizing which phase of the curve you're currently standing in. There's a second pattern worth naming directly. Many investors compare their dividend income to their portfolio's price performance and use that comparison to judge progress. That comparison is misleading because price and income don't move on the same timeline. An investor watching only the price chart will conclude the strategy is underperforming long before the income tells a different story. A more useful habit is tracking dividend growth rate year over year, separately from price. When the income figure keeps climbing, even during a flat or falling market, that is the signal the strategy is intact. The viewer's reaction to seeing this clearly is usually relief, not excitement. Relief because the criteria no longer depends on what the market is doing today. None of this is a prediction about where the market goes next. It's a description of how this particular approach is structured to behave. The flat stretch you may be standing in right now is not new, and it's not a warning sign. It's the part of the timeline every dividend growth investor passes through, whether they recognize it or not. The only real decision left is whether you stay long enough to reach the part of the curve where the growth becomes visible. That decision doesn't require certainty about the market. It requires sticking to the criteria you set before the doubt started. The criteria don't change just because the chart looks quiet. That's the whole point. Compounding quietly. Slow, steady wealth building. If this helped, subscribe and leave a like. Everything here is for informational purposes only. All final decisions and responsibilities remain with you. Thanks for spending time with Compounding Quietly today.